There is a phrase that has been surfacing with growing regularity in policy rooms, in scholarly publications, and now in confirmation proceedings on Capitol Hill. That phrase is financial repression. And I want to tell you that the people using it in those rooms understand precisely what it means, even if they choose not to state it directly. Financial repression is not a fringe theory. It is a documented, historically validated policy instrument that governments deploy when their debt becomes structurally unmanageable. The United States employed it for nearly 3 decades following World War II, and the conditions that made it necessary then, a debt to GDP ratio exceeding 100%, a government unable to cut spending or raise taxes enough to close the gap, are present once again today. The question is not whether financial repression is approaching. The question is whether the version arriving now can actually function the way it functioned in 1946. And I think the candid answer to that question is more layered than anything you are currently hearing on social media. There is a phrase that has been surfacing with growing regularity in policy rooms, in scholarly publications, and now in confirmation proceedings on Capitol Hill. That phrase is financial repression. And I want to tell you that the people using it in those rooms understand precisely what it means, even if they are careful not to state it openly in public. Financial repression is not a fringe theory. It is a documented, historically validated policy instrument. The United States government employed it deliberately and systematically for nearly 3 decades following World War II. It transferred an enormous quantity of wealth from one segment of Americans to another, silently, without a single congressional vote, without a single politician ever having to explain it to their constituents. And the conditions that made it politically necessary then are present once again today. The question I keep posing to myself, and I have been asking it with growing urgency over the past 18 months, is whether the version arriving now can actually function the way it functioned in 1946. And my candid answer is, the mechanism is identical. The environment it is operating within is fundamentally altered. That difference is what I want to explain today, because it is the difference between a gradual, manageable transfer of purchasing power and something considerably more disorderly. I want to establish my perspective before we proceed any further. I have been managing capital through multiple debt cycles since the 1970s. I watched Paul Volcker deliberately break the inflation of that era by pushing the federal funds rate to 20%, a decision that was brutal for debtors, brutal for the equity market in the near term, and ultimately the correct call for the structural integrity of the dollar. I have watched the Federal Reserve and the Treasury navigate the aftermath of the savings and loan crisis, the dot-com collapse, and the 2008 financial crisis, each time drawing a different tool from the same basic policy kit. What is being discussed now, whether you call it the Walsh Plan, the financial reset, or simply the only arithmetic that makes the debt sustainable, is not new. The label changes, the mechanism does not. And the mechanism has a very specific and very predictable set of winners and losers. What I want to do is show you which side of that trade you are currently positioned on. Let me begin with the number because the number is real, and the trajectory is real. The U.S. national debt is approaching $36 trillion. The annual interest payment on that debt has surpassed $1 trillion, more than the entire defense budget, more than Medicare, more than any other single line item except Social Security. Every conventional analytical solution to this problem is effectively unavailable. Raising taxes enough to close the gap would require increases of a magnitude that no modern democracy has successfully executed without triggering severe economic contraction. Cutting spending enough to matter would require touching Social Security, Medicare, and defense, the 3 categories that constitute the majority of mandatory and discretionary spending. And the political system has demonstrated repeatedly that it cannot do this. Growing out of the debt requires the economy to expand faster than the debt, which is currently accumulating at approximately $7 billion per day. At current trajectories, that arithmetic does not resolve, which leaves one option. The option that requires no congressional vote, the option that operates quietly over years without most people understanding what is happening to their savings until the process is well advanced. That option is financial repression. Here is the mechanism precisely. Financial repression occurs when a government holds the interest rate it pays on its debt below the rate of inflation. When the real interest rate, the nominal rate minus inflation, is negative, the debt's real value erodes over time. A government that owes $1 trillion at 2% interest, while inflation runs at 4%, is effectively paying a negative 2% real rate. Every year, the real burden of that debt shrinks by the difference. The debt does not vanish. It is not canceled. It is not defaulted on. It simply becomes worth less in purchasing power terms, which is another way of saying that the people who hold it, primarily savers, bondholders, and pension funds, are quietly absorbing the cost. This is what happened in the United States between 1946 and approximately 1974. The debt-to-GDP ratio declined from 106% to 23% over that period without a single default, without dramatic austerity, without sweeping tax increases. The mechanism was a combination of moderate inflation running consistently above the interest rates the Treasury was paying, because the Fed and the Treasury were operating in coordination to keep those rates suppressed, combined with robust economic growth in the post-war expansion. That is the historical precedent, and it is a genuine precedent. It worked. Now, here is where I want to be precise about the distinction between 1946 and today, because this difference matters enormously for how you should be thinking about your portfolio. In 1946, the United States was the world's dominant creditor nation. We had emerged from the war as the only major industrial economy with its productive capacity undamaged. The rest of the world needed dollars to rebuild. Demand for dollar-denominated assets, including U.S. Treasury securities, was organic, structural, and enormous. When the Fed and Treasury suppressed interest rates below inflation, foreign and domestic buyers continued to hold Treasury debt because the alternative, holding the currencies of devastated European economies, was worse. The United States had pricing power over its own debt in a way that no other country in history has possessed before or since. Today's situation is structurally different in several critical respects. The United States is now a net debtor nation, with a net international investment position of approximately negative $26 trillion. The dollar's share of global reserve currencies has declined from 71% in 2001 to under 58% today, and that decline is accelerating. Foreign central banks, the institutions that were the most dependable buyers of U.S. Treasury debt for decades, are systematically diversifying away from dollar assets and into gold and alternative reserves at a pace not witnessed since the Bretton Woods era. And the buyers who have stepped in to replace them are primarily domestic. The Federal Reserve itself, domestic banks, and retail investors through money market funds and bond ETFs. The question that the financial repression playbook from 1946 does not answer is this. If you suppress interest rates below inflation, who purchases the Treasury debt at those artificially low yields? In 1946, the world bought it because there was no alternative. Today, the world has more alternatives than at any point since 1944. That changes the feasibility calculation for financial repression in a way that is not reflected in the simple historical comparison. Let me be precise about what Kevin Warsh has actually stated publicly, because the social media framing of a secret plan significantly misrepresents a more nuanced set of policy positions. Warsh has been critical of the Federal Reserve's expanded balance sheet, the approximately $7 trillion in assets it accumulated through quantitative easing programs. He has described himself as wanting to pursue what he called a regime change at the Federal Reserve, by which he means a more rules-based approach to monetary policy rather than the discretionary meeting-by-meeting framework that has characterized the Bernanke, Yellen, and Powell eras. He has expressed concern about fiscal dominance, the risk that the Fed becomes effectively subordinated to Treasury financing needs rather than operating independently on its inflation mandate. These are serious, coherent policy positions. They are not a secret plan to cancel the debt. They are, if anything, a description of the tension between what sound monetary policy would require and what the fiscal situation may ultimately compel. The confirmation process itself illustrates this tension. A Fed chair who genuinely intended to suppress rates below inflation to erode the debt burden would be doing precisely what Walsh has publicly criticized. The gap between the social media narrative and the actual policy substance is significant. This is where I want to focus on the capital flow data because it is more revealing than the political narrative. Central banks globally have been acquiring gold at a rate not seen since the 1960s. The People's Bank of China has added to its official gold reserves for more than 18 consecutive months. The central banks of Poland, India, Turkey, and Hungary have made substantial gold purchases, each citing reserve diversification as the explicit rationale. These are not speculative purchases. These institutions move deliberately, methodically, and with extraordinary attention to long-term structural conditions. When the institutions that manage the world's reserve assets systematically reduce their exposure to dollar-denominated government debt and replace it with gold, they are making a statement about their confidence in the long-term purchasing power of the dollar. That statement is more meaningful than any post or social media claim about hidden plans. The market is pricing something. The question is whether most American savers are positioned to understand what it is pricing. Let me translate the macro framework into specific implications for the people most affected by what I have described. The group most harmed by financial repression is straightforward. It is anyone whose wealth is stored primarily in assets with fixed nominal returns. Cash in savings accounts earning 3 or 4% while inflation runs at 4 or 5% is a guaranteed loss in real terms. Long-duration bonds, the 20-year Treasury ETF, any bond fund with an average duration above 8 years are exposed to a specific and severe risk in the financial repression scenario. If the government is attempting to keep nominal yields below inflation, there will be periodic market episodes where the bond market resists that suppression and yields spike. The 1970s were filled with those episodes. They were damaging for long-duration bondholders. And the 2022 bond market, the worst year for U.S. Treasury bonds since the Civil War era, was a preview of what that dynamic looks like. The people who performed well during the post-World War II financial repression era were without exception holders of real assets. Equities in companies with genuine pricing power. The ability to raise prices as costs rise performed well because their nominal earnings rose with inflation. Real estate with fixed-rate mortgage financing was an extraordinary beneficiary. The real value of the mortgage debt eroded while the real value of the property held. Gold was officially suppressed in price during that era, but the broad commodity complex performed well. Businesses that owned physical productive assets, factories, farmland, infrastructure, resource deposits retained their real value in a way that paper claims on fixed cash flows did not. I want to address something that arises frequently when this topic is discussed, because I think it leads people toward a false conclusion. The argument goes, international diversification is the solution. Own foreign stocks, foreign currencies, foreign bonds. And while I understand the intuition, I want to challenge the mechanical application of it. The financial repression dynamic is not unique to the United States. Every major developed economy, Japan, the United Kingdom, the Eurozone, is managing versions of the same debt trajectory. Japan has been running explicit yield curve control, a textbook financial repression instrument, for nearly a decade. European government debt to GDP ratios are at or near historic highs. The British pension system nearly collapsed in 2022 precisely because of the dynamics I have described. Long-duration bonds, financial repression, and a sudden market repricing. Diversifying into international assets that are subject to the same macro forces does not eliminate the underlying risk. It distributes it differently. The assets that genuinely preserve purchasing power across financial repression episodes are real assets with intrinsic scarcity, and that category transcends national borders. The final point I want to make is about the Federal Reserve's institutional position, because I think it is the most important and least examined variable in the current setup. The question of whether the Fed is technically federal or privately structured is less important than a more fundamental question. Does the Federal Reserve have the institutional independence to pursue the monetary policy its mandate requires, or will fiscal pressure gradually subordinate it to the financing needs of the Treasury? That question was resolved in 1951 when the Treasury-Fed Accord formally separated monetary from fiscal policy after the wartime period of coordinated rate suppression. The 23 years between 1951 and 1974, when the debt-to-GDP ratio completed its decline, were years of positive real interest rates and genuine Fed independence. The financial repression of the post-war era was completed precisely when the Fed reasserted its independence. The current discussion about a new Fed chair, the relationship between the Fed and the Treasury, and the political pressure on monetary policy is, in my reading, a discussion about whether the 1951 Accord holds or whether the conditions are being created for its gradual erosion. A Fed that is operationally independent will resist yield suppression below inflation, which means the debt burden resolves slowly through growth and modest inflation, the favorable scenario. A Fed that is gradually subordinated to fiscal needs will suppress yields more deliberately, which means faster debt erosion, but also faster purchasing power erosion for savers. I do not know which path we are on. What I do know is that the current positioning of most American retirement portfolios, heavy in long-duration bonds, heavy in cash, light in real assets, is the positioning that suffers most in both the favorable and the adverse scenario. That is the asymmetry I think most investors are not seeing clearly. The market is telling you something about the long-term value of paper claims on fixed cash flows. The central banks buying gold are communicating the same thing in a different language. The question is whether you are attending to the right signal. If this framework is valuable to you, subscribe and share it with someone whose retirement savings deserve a clearer explanation of what financial repression actually means for them.